it's very nice to be back again. I think I was here, spent quite some time, 12 years ago, and even write some papers. So actually my career in some sense also started with here. So while my title here is long, actually 50% already taught by, Ronnie Sirka plus Wolfgang Hedler. So Wall Street people give me a nicer title called, equity risk modeling. Actually this is the way, actually how after they find my paper and they change title to equity risk modeling. So, okay. So here's the outline of my talk. So I'll give a brief introduction. So, and then I'll talk how to estimate large covariance matrices and based on factor model. And in order to compare the performance between factor model, so I'll also use sample covariance matrix as a comparison. Let's see, does it work? Wait a minute. I think that should work. Okay, good. Yeah, yeah. Okay, so so this is the article, and then we'll talk application of our theory to portfolio allocation, particularly on the impact of risk assessment and the portfolio allocation. So, and finally, all the theory I'll verify by using simulation models. So really, I changed a little bit of talk, to be here because a lot of my colleagues are here, and I thought it's very nice that this kind of conference, not only that, I got a chance to meet, friends and colleagues here, but also I could also get a chance to present my talk to my friend and colleague. Otherwise, we would go to a different conference.
They don't listen to you when you're in Princeton.
Right. They don't. Then they have other business. Now they are here. So to the group. So again, stop me anytime. But my introduction a bit long because, as I said, it was prepared to be a 45 minutes talk, and now become, and now in 30 minutes talk, now become 45. So volatility matrix, everybody knows, to this audience, has wide application in financial econometrics. So it's measure the risks associated with capital requirement and the risk management used in assets pricing and proprietary trading. And for example, one particular firm that I'm working with, they bought software. If you give me mu, and give me sigma, so the outcome is how to allocate, right? So apparently mu and sigma, that the return and the volatility you need to get yourself, to estimate yourself. And actually this is how they find this. And also if you move beyond, financial application is also critical for genetic network and climatology and so on. So there are lots of things about about this. So let me just to put ourselves in perspective what the problem I'm thinking of. So estimating high dimensional covariance matrix is intrinsically challenged. So suppose I just give you 500 stock to be managed. So there will be, if you use non-parametric methods, model-free method, there will be involved 125,000 parameters. If I give you 2,000 stock to manage, you'll involve over 2 million elements. Now, everybody says that Markovitch, theory doesn't work in practice. One reason maybe is this, like if I give you 2,000 stocks and you apply Markovitch, optimal allocation formula, so at the end of the day, you need to inverse a 2,000 by 2,000 matrix, and each of those being estimated involve 2 million parameters. Each of those have very small error. Aggregate those together. At the end of the day, the allocation vector you really want, that is Oracle, allocated vector, and the sample covariance estimated vector could be quite far apart. Okay, so the number of data actually available for us is usually limited, say 3 years, 750 trading days. So so estimating high dimensional covariance matrix is really a challenge if you think about it, and something doesn't work. Not necessarily the theory doesn't work, it's just that the theoretical allocation vector is over there, and once you do sample covariance matrix, aggregate over 2 million parameters, you maybe go to this direction, and that could be due to that. Okay, so this is, and people may say, oh, well, how about high frequency data? Well, there's still a lot of problems with that because there's highly correlation among those traded data, non-synchronized trading, and so on and so forth. So there's a lot of problem if you use high frequency data. It doesn't solve you the problem. And so certainly we need some kind of dimensionality reduction. I mean, and depending on the area of applications, you use different kind of dimensionality reduction. So for financial application, the most, most popular model be factor models. So Lonely Circa talk about this, and Wolfgang Heather talk about this this morning on factor models. So for example, within sectors, you're thinking they share the same risk. Across sectors, you may think they are. They have very different, share different kind of market risk, and so on and so forth. So you could put down the model, and this is actually the work that I'm going to follow. But before I go to the work you are going to follow, so let me just pose you a very simple question. So suppose that I give you a very nice X that is n-dimensional, as simple as you can think, with a covariance matrix, identity matrix. Okay, so this is the simple multivariate setting. Now suppose I give you n sample size of n. Okay, so you have n vector of n vector of p-dimensional space. So you got your sample covariance matrix, right? So you ask yourself, what is the eigenvalue? How close the eigenvalue of this high-dimensional covariance matrix to this identity matrix? So when n and p are in comparable order, we all know this have to follow what's so-called arc-sine law. And when n bigger than p, the spectrum diverge. So you will not go to eigenvalue will not be close to 1. So when n much less than p, and so n p much less than n, then you got the convergence. So, but anyway, so this is the motivation of my talk, and there are certain other kind of sparsity modelings in other contexts. So let me not bore this with audience here. And the main, motivation of this certainly is rooted back to finance theory, that the capital assets pricing model, which basically says that one factor would be sufficient to to capture cross-sectional risks. However, in the real world, it's always difficult to find what's so-called market portfolio. It's always a proxy, and so therefore it doesn't surprise that you find a lot of anomaly literatures basically says that there are some PE effect, there are size effect, book-to-market effect, technical effect. That is, if I buy, let's say, hold a low PE ratios for a couple of years and the sale on the high PE ratios, and or you could get them higher return than market returns, and so on. So there are a lot of anomaly literatures appears in the 70s that there's a challenge to, capital assets pricing model. And so one way out, certain people will say multi-factor model, this which is really, the talk, the actual Wolfgang talk, but it's in a very different context. So for this talk, I let yi be the excess return of i's asset. And these are the factors. I have k factor that may influence the return. And so the multi-factor model, as derived by Steve Ross and by using arbitrage pricing theory, or by Chamberlain and Rothschild in the large economy, which basically says that the ith return depends on its factor loading on the first factor and the kth factor loading on the kth factor plus epsilon I. Okay.
Return is return over market?
So in the theory, it should be return over the risk-free interest rate. Yeah. But in practice, certainly will take 3 months treasury bill or 1 month as a proxy. So here epsilon I, the same as the name that equals syncretic noise, and of course then this referee always has a lot of power, saying that how about the modeling biases? Actually, he moved me into a wrong direction, which I like to, rather than I'll talk a minute. So in my mathematics is cheap. So in my paper, I force myself to even let k, the number of factor grows with sample size n. Okay, so if I do this, so the number of dimensionality being reduced by exactly like in the original, let's say by this factor p divided by k. That is what is the number of maximum factor you could have for a p-dimensional vector? So you at most have k factors. So p factors, right? So this will reduce by a factor of p divided by k. So this is the dimensionality reduction. So Okay, so now the famous model in finance, if you ask Pharma and French, and they are still talking, like even last year in Wharton finance department, that they believe that you should use 3-factor models or 5-factor if your portfolio include bond. Okay, so 3-factor are CRSP value-weighted index, so which is a proxy for market portfolio in America. And different between large cap and small cap, so this is size effect. Different between return on high and low book ratios. So this is a factor that capture the value effect. And of course, if you really, your portfolio involve bond, then you have term structure, the yield spread between long and short-term bonds, and default risk, that is high and low grade bonds. So these are 5-factor models. So, and actually, after I write this paper, I got involved with this emerging market portfolio location is some guy apparently Googled high dimensional factor model and found me. So they brought me a very interesting question, and you'll see that why I say I would rather work instead of asking what if my model is wrong, I think I'm more worried is what if my model is too flexible, what if I'm overfitting. So, pardon? Oh, okay. Okay, but N, P could be N is equal to P here? Oh, N, I'm sorry, yeah, P, I'm sorry, yeah. This is P, thank you. You see the type of P. So they have 2,000, they call investable, stocks. And of course, then you would say, okay, the return in the emerging market is equal to the overall, market portfolio. That is the return of emerging market universe, and the country factor, industry factor, and the style, how you invest. And then, of course, the question people may ask here naturally is, I don't want to invest on 2,000 stocks. I really only want to invest 150, pick and choose something. So how do I allocate portfolio efficiently, robustly, and sparsely? That means I really only invest a part of them. And how do I choose those factors? So certainly these are the questions that you naturally will ask. And so actually they apply factor models, very slightly differently from what I talk here. But actually, Ronnie Surkar give a very nice, overview on credit risks. So, and I didn't realize that he give this kind of talk. So anyway, so I just put a similar slide, but there's no way I could change it. Otherwise, I could just have delete it. Let me go very quick. So by the end of 2006, so 6 months more than what you said, the number doesn't contradict. So there are about 30 trillion. The credit derivative market, and as Ronnie showed you, there's grown rapidly with CDS and synthetic CDOs, and here are the key market participants. So basically, like banks, hedge funds, bank loans, and so on. And here just a little bit more detail about how much is in each category. So let me not go any detail of this. But really, I want to get is what Ronnie talked this morning, so I don't really need to talk more. You have 125 for CDX type of, CDX, type of, let's say, collateralized debt obligations. And I have 125 names here, so I need to know the correlation among those. And Ronnie gave a very nice modeling by using factor model this morning, and certainly he's more concerned how to model correlation between those two, and I'm more concerned on the other hand, if I put a lot of parameters there, I have limited data, and at the end of the day, do I get once parameter being calibrated, do I get the thing that I want? In other, so it's a different aspect of Ronnie's talk, but nevertheless, the talk I'm talking here is mainly on equity. It shares some kind of lessons that in Ronnie's credit derivative scenario. Okay, so now here let's go to mathematics. This is enough for introduction. So again, mathematics, remind you, is I assume factors are observable. People say, well, the first question you may ask, what if factor is not observable? That would be a little bit more challenge, but you give a very nice result. Observable and not observable doesn't make very much difference. Okay, so in this case, so it's really a statistical regression problem if you, for those people who want to be like, put yourself in the terminology that you are familiar with. So the I stock at the t period, so this is the SS return, is written as the return of the first factor plus its factor loading, the kth factor and its factor loading plus epsilon. So if I write in matrix form, I got this matrix form. So this factor model certainly imply model-based covariance structure, which is the covariance matrix should be equal to B times variance of this factor and B transpose. So the B is the matrix of factor loadings. Thinking is 500 by 3 if you use 3 factor models, right? So you have 500 by 3. And this F is 3 by 3 matrix because I have 3 factors. And epsilon is idiosyncratic noise, so like Ronnie's talk or Wolfgang's talk. We assume they are independent. So in other words, sigma 0 would be diagonal. And in order to satisfy the referee, so I assume that the number of factor k had to depend on the number of stock that you are using. So we allowed that to k to depend on p. And in order to understand the impact dimensionality on the estimation of covariance matrix, so I'll let P to depend on N, right? So P depend on sample size. The dimensionality depend on sample size. So as a result, so this is equivalent to say that K depend also on N, okay? So the sample size I have. So now I have 2 estimators here. One is you just do regression analysis. So each of these is a regression model. For each individual stock, this is a regression model. So you run this regression model over 3-year period or 1-year period, depending on how much regulatory allows you to use the data. In the risk management, people maybe say you can only use 1 year. Right? So you run this, you got those estimated factor loadings, and you substituting here, and these are just 3 by 3 sample covariance matrix put here. You got your residual variance, you put in the diagonal there. So you got the factor model-based estimator. On the other hand, you could get just non-parametric-based estimator that don't assume anything, so you got this. And the reason I put in these 2 together, so I got a scale to compare how good the performance is. Okay, so now here a few questions people ask naturally. So how does estimation error grow with dimensionality or with a number of factors? How large can P be such that the number of stock you have, such that the error in the estimation is negligible in portfolio location or in risk management? And you may ask, how does factor model-based covariance matrix perform compared with sample covariance matrix? Under what kind of situations factor model-based approach game substantially better or just marginally better? So let's build some theory first, and then we'll go to what the practical implication of those. So the first theorem, yeah?
So can you just run what is P sub N?
Oh, what is P sub N? Okay, P is the number of stocks, okay, and the N is the sample size. So in order to see that the number of stock is large, so I need to let this P grow with sample size, just like let P be large. N go to infinity. N is the sample size. P also go to infinity, yeah. So at what rate, say actually this is part of the study that I want to make. Yeah. So so it's really, in practice, P is really Pk is K, but in theory, I need to link those, otherwise you will talk about finite dimensional estimation. Yeah. Yeah. Computation?
No, implementation and also identifying the factors.
Oh, okay. So here I took, Farmer and French approach. Just say, okay, these are the 3 factors: market portfolio, size effect, value effect.
I understood that you are saying that increasing
K. Yeah. Okay.
Number of
factors. Yeah.
You should also increase the number of factors.
Yeah, so in theory, I allowed the number of factors even to grow with P. Okay, so in theory, I'm just trying to understand what is the estimation error. And then I'll go back, and while referee moved me in the wrong direction, I really want to say shrink the factor rather than grow the factor. But in mathematics, as I say, is cheap. So if they wanted, I mean, you're just adding k to depend on n just to satisfy them, so you just need to check more carefully each of these terms. So the first theorem basically says that, so the factor-based, the eigenvalue, so this is the first part I'm talking about is convergence in matrix. Okay, so the second part I'll talk about, I mean, is implication on financial, portfolio allocation and risk assessment. Okay, so the kth eigenvalue, and this is your sample-based, model-based, and this is the theoretical-based. We basically say the maximum of those will converge quite slowly depending on how many parameters you have. K times P really is the number of parameters you have in the model, and divided by N. N is the sample size. So in other words, even if I use 3-factor models, you cannot do more than square root N number of stocks. So if I give you let's say 400 trading days, you shouldn't use more than, let's say, 20 stock according to the theory, right? So P is appropriate a square root of N, even if number of K is that. Then people may ask me naturally, say, okay, is this rate optimal? And I'll show you a toy example. Actually, the rate I show here is optimal. You cannot improve, you cannot do better than that. So what is the practical interpretation of this is that, this actually I go back to, actually hedge fund guy is doing smarter than I have. This is actually the second stage of theory we haven't built. So 2 years later, when we have a similar conference, I'll talk about second stage theory. So I think the problem I have here is each factor has different factor loadings. So the number of parameters is still too large. So if I assume they have constant loadings, this would be like a Gaussian copula that you are talking about, which have constant or implied correlation that you are talking about, Wolfgang talking about this morning. Then in this case, you have identical the same loading. Then the number of parameters is much less. Then you could estimate much better. Even with 1-factor model, k equal to 1, my rate of convergence here can only Pn divided by n. And this is the optimal, I'll show you. This is not like due to, my math qualification, it's just mathematical problem associated with it. Okay, so our summary basically says that it doesn't help us in estimating the covariance matrix, and therefore doesn't help me very much in assessment of the risk. You'll see what I'm trying to say here. And so let me just be quick. So now how about let's discuss about the estimation. Let's say what kind of norm. Let's say in matrix. The first one I to show you is using eigenvalues. So despite the popularity, the Frobenius norm, which is the quadratic norm in this form, is not appropriate for our understanding. Let me give you a toy example. Suppose that factor loading, I have only 1 factor. And lucky enough, factor loading is all equal to 1. So there's no, there's no uncertainty in given factor loading. And the equal-synchronic noise also known to you, also identity. So in this case, covariance matrix will be equal to this, right? So now I just need to estimate this parameter, this little guys here, the variance of f. So the Frobenius norm, if I estimate here with a small error, then it would go to every elements of matrix. So therefore, the Frobenius norm will be amplified by a square root of Pn squares. So as a result, everything that you've seen before, that inflated by n is from there. So the same way for this particular example, the largest eigenvalue is this. So it's a Pn squared times variance of f, and the rest is equal to 1. So if you look at this, the maximum eigenvalue would be inflated by Pn squared. So therefore, the rate of convergence you do, because at least you need to estimate variance of f would be root n, right? So the rate of convergence you see would be this rate, because the elements being amplified by by that much. Okay, so let me. So the other way that we use is quadratic norm, which is this, that is sigma times this sigma, which is really sigma and sigma inverse minus identity matrix. And then I just normalize by P here. And this is closely related to what's so-called entropy loss between the two, let's say, Wishart distributions. So theorem 2 basically gives us some positive results. That is, the theorem 1 is quite negative. Basically, say factor-based model doesn't help you at all to estimate the sigma. So theorem 2 basically say factor-based model would improve the rates of convergence if somewhere in your measure, you involve the inverse of sigma, okay? So this is Bayesian theorem 2. So if you look at the rates of convergence, it looks complicated, but just thinking k is alpha 1 equal to 0, so that is k is constant. So then the rate of convergence for a factor-based model is this, and the rate of convergence for, that is the number of dimensionality could go this high, and the rate of convergence for sample covariance matrix base is like this. So you could see that the improvements in terms of estimate using this quadratic norm. Okay, so you could see the improvement by using a factor model. And the theorem 3 basically says more explicitly that is, if I estimate sigma inverse, and so this is the factor-based model, and this is the Frobenius norm, then the rate of convergence again is Pn squared divided by n. Just forget about k go to infinity, just thinking k is 3 factor models, okay? And this would be an order of magnitude smaller than if you use sample covariance matrix. So we can see from these 2 examples, whenever you estimate involve sigma inverse, then factor model, so whenever you involve a sigma inverse, factor model based estimator would be performed better than the sample covariance matrix. So if you involve with sigma alone, then factor model based estimator would perform just the same as the other one. Okay, so this is a one-line summary. Anything involves sigma inverse, you'll get gain. And how many dimensions you can go? Again, you can see just log n, square root n dimensionality. Certainly, we could talk about asymptotic normality, which is quite complicated, so let me not talk about this. Now let's talk about impact on portfolio allocations. So this is the Markowitz problem. So you want to minimize the risk of your portfolio subject to the total allocation vector is equal to 100% and expected return equal to some given value. And you could easily solve this little quadratic programming problem. So the solution explicitly depends on sigma inverse. And so therefore, you expect that naturally, if you use factor-based model, it will give you a better estimate. Okay, so again, you could ask 3 questions. How does it impact on the resulting portfolio, variance if I put my factor-based model estimation and put it here? That is, how does it compare with Oracle? If somebody tell you the true sigma and you use it, and someone don't tell you, you would just estimate it, and how does it, how does the result impact on the portfolio variance? How does it impact the allocation vector, and how does sample variance compare with the factor-based model for these purposes? So this is the first result I show here. Basically says that if you do substitution using a factor model, and this is the true variance, that is the Oracle variance that you are aiming at, and the error would be accumulated by p to power 4 divided by n. Okay, so in other words, now we are talking even worse. That you can only do up to n to 1/4 rate. So you cannot have very large covariance matrix to let everybody have itself have a factor loading. Okay, so and if you use sample covariance matrix will perform even worse. So it is exactly the number of parameters I'm showing here worse. And similarly, you could show the similar result for a global minimum portfolio. That is, you minimize a Markowitz problem without this constraint, without saying that your total return want to be 10% or something like that. Then again, the rate of convergence is Pn divided by n. So here I just show you exactly the accumulation effect of estimation error. Remember, I have Pn times k number of parameters there. And this basically amplify, and then each of those have accuracy 1/n. So this is the rate of convergence. Now, how about the impact on the risk assessment? That is, if I give you a location vector, and you ask me how much the risk do I have there, then your estimate would naturally be this guy, right? So it's your either sample covariance matrix or factor-based model estimator. So you're substituting here. Then our theorem basically says that the rate of convergence is this. Again, Pm4 divided by n. So you cannot go using factor model for a too large covariance matrix because accuracy that you obtain there would be 1/n, would be amplified by each of those. And a little bit sad here basically says that if you use sample covariance matrix, then you will get exactly the same rate of convergence. And so this is exactly what I said. If you estimate sigma, you using factor model doesn't gain. If you estimate sigma inverse, then the sigma inverse also have factor model correct structure. Then you could gain some results. And let me show you just some simulation to demonstrate this. Okay, so our simulation model follow very closely to the recipes in the Pharma and French website. So we use 3 years data of 30 industrial portfolios from 2002 to 2005. So you could see the first draft must be finished around somewhere in 2005, right? So, and here are the factor loadings. So if I have 30 industrial portfolios, then I have 30 factor loadings. So I summarize those 3 factor loadings on 3 factors, right? By the mean vector is here, and the variance factor of those 3 factor loadings, 30 of those, right? Remember, I just summarize a variance sample covariance matrix equal to this. And also I have I also have the return of my factors, right? 3 factors. So this is expected return over this period, and this is the variance over this period. And if I do model fitting, I will get standard deviation of 30 equals syncretic noise, and they have average equal to this and standard deviation equal to that. So now I take these estimate thing as if is my oracle, that as if true parameter, I do simulation. So I simulate 3 years data from the factor is coming from the factor, the parameter I take in just exactly the same as fitted and as market data. And then I generate loading from these normal distributions. And now I need to generate equal syncretic noise. These are chosen from gamma distribution to match the first 2 moments that I have. And after that, of course, you got, let's say, as many simulation as you like. And here is the accuracy, comparison. So if I use Fabinus norm, this is sample covariance matrix, which the mean square error grows with dimensionality. So here, I'm plotting here is the dimensionality range from 0 to 1,000 dimensions. Okay, so and this is the factor. This is the factor-based model. So this is matched pretty much with our theory. Factor-based model doesn't improve very much the sample covariance matrix for estimating sigma itself. However, if you use this norm, then you can see the difference. This is factor-based model. This is the sample covariance matrix in terms of accuracy as measured by this. And if you like, you could use entropy norm. And they have very similar behavior. This is just sample covariance matrix. So now similarly, if you're talking about estimating sigma inverse, this is the factor-based model as dimension number of stock growth. And this is the sample covariance matrix. So you could see the improvement, clear improvement of factor model over the sample covariance matrix. So anything involves sigma inverse, you could get improvement. And similarly, then you could discuss about the impact on portfolio allocation and minimum variance. So here, what I'm showing you here is this is factor-based. This is a sample covariance-based model for optimal portfolio allocation variance, and this is the factor-based model. So there's clear improvement over there. And finally, I'm talking about risk assessment. That is, if I give you equally weighted portfolio and I do this simulation 500 times, and as dimension grows, certainly, the diversify effect, the variance, of course, increases with number of stocks. But nevertheless, if you compare the factor-based model and the sample covariance-based model, you cannot see the differences. Actually, I plot 2 lines here. You're barely able to see any differences between the 2. So this basically confined with what I talk here. Sigma, if you're estimating sigma, you use factor model, it will not improve anything. If you estimate anything involves sigma inverse, then you use factor model, again, you quite something. So now I give you a quite quick conclusion. Am I running over time or reasonable? Oh, good. So I have enough time to talk about conclusion and outlook. Okay. So, this is not done. I have outlook. Okay. So we proposed and studied the use of factor model for estimating high-dimensional covariance matrix. And what is the conclusion we said? So when dimensionality is high, the factor model-based estimator will significantly outperform the sample covariance particularly anything involved inverse matrix, right? This I just repeat many times. And the reason is, if you have factor model, you inverse this guy would be also have a factor model structure. And this would so therefore it would be significantly outperform the sample covariance matrix in portfolio allocation, because portfolio allocation involves this, right? Doesn't involve this. And however, it doesn't improve the performance on risk management, because risk management involve this, because you're estimating the risk, the variance of your estimate involve this rather than this. So this is consistent with what I said. So now looking back to the mathematical result we show here, as I told you, I'm not smart, but I'm also not dumb enough. Most of those results are optimal. You cannot improve, just as intrinsically mathematical results. So you can only go up to P, let's say P divided by N. So mathematically speaking, you can only allocate, if I give you sample size, let's say 2 years data, 500, you can only allocate your vector all the way up to N to 1/4, because that would be very low. You can, let's say if I have 600 stocks, or 300 stocks, my accuracy would be very wrong. So in other words, if your target is here, if I use true sigma, your target maybe is there. But if once I use estimated one, because error accumulation, it may be target completed over there. And this is the mathematical result basically showing us how the impact it is. So now how do we do from here? So if we go back, I think all the results here is because I'm too flexible. That is the factor loading. Each individual stock has its own factor loadings, and has its own factor loading. So therefore, the number of parameters I have is still a lot, right? If I have p dimensional, I will have p, right? This is I have p stock times k plus 1, right? So I still have a lot of parameters here. Now, particularly when P is pretty large, I still have a lot of those. Now, if you look at those people, we were talking about factor models with those, with those hedge fund guys, and they write something like this, and it's taken me quite a while. What do they mean by something like that? Of course, we don't write any mathematics further. That doesn't allow them to write anything further. What I'm thinking is they really saying that the factor loading, for a country, let's say I have 20 stocks for a country, the factor loading of that stock, let's say from China, on this C is identical, okay? The factor loading on emerging market is identical. Then it's reduced a lot of parameters. The factor loading on industry is identical. So going back to the model I'm talking here, so I think in their implementation, they assume all those BIs are the same for some more homogeneous subgroup, and that will reduce significantly. Then the number of parameters will be much, much less than this. So, this is, I think the implication of this is basically saying that, now thinking it back, referee asked me to put K larger just to satisfy us more non-parametrics, actually pushing me in the wrong direction. Rather, I should use 3 or 4 factors, or maybe 5 factors, but reduce my parameter further to a smaller subset so that I have less parameters here. So, okay, so now if I look at this, so now let's see what Nobel Prize guy would say. How do they do that? Okay, so this is our look. Okay, so I look at the Rob angle, and Rob angle, of course, would be, paper got rejected if you don't have mentioned Gauch. There's a bunch of people in econometrics. Everything must to have a name Gauch there. So this, he basically assumed this very simple. Okay, so let me do model marginal each stock, just like Ronnie's talk this morning, right? It's just like each individual stock. Let me do by Gauch 1-1 model. So this is only 2 parameters, not big deal, small. So now, so once I do this, people will say, let's de-Gauch it, all right? So let's just standardize it. Then he will assume the equal correlation. That is, among 200 stocks, they have only one correlation rho. This is really one factor model with the same factor loadings, right? So this is Robert Engel doing, and I think he's pushing quite hard on this. And now if you look at my mathematical result, he has a point, because if I let all those be to be quite flexible, then the rate of convergence is I mean, the accumulation of error is just way too large. Of course, Rob Engel didn't study any mathematical properties, but if you think about that, it's reasonable. And actually, in longitudinal studies, we did a very similar kind of things. Because of availability, I estimate maybe marginal covariance by something, and then I put a parametric model on the correlation model. Okay, so this is really the factor models with equal. That is, in order to make it more practical, that is the estimation error, you are not too flexible, you probably need to add in some structure to the factor model. Rather, using 3 or 5 or 10 factor you like, but at least you need to put a lot of constraints on your factor loadings. So this is what I maybe call equal loading models. And then the other way that deal with this is probably could be doing also called the sparse allocation that actually the emerging market and the hedge fund guys were talking about. So they really want to say, okay, somebody give me the return vector mu and give me sigma, then they buy a software which basically say how much to allocate and which stock to allocate. So the problem actually is similarly to this kind of problems. That is, you want to maximize Markowitz utility optimization. This is Markowitz utility optimization subject to the fact that you don't put, you don't do too much on, any portfolio weights. So any stock shouldn't get too much, let's say, too much short or so on. This is the L1 norm that I'm putting here. And with this, then when you estimate sigma hat here, the sigma hat error would be less influential because I maybe only, even though I had 2,000 stock, at the end of the day, I only allocate on, really only 50 stock were chosen. So this objective function would be far more, far less dependence on sigma because then you really, indeed you have 2,000 stock. At the end of the day is you have maybe only 50 or 100 stock you locate here. Then your dimensionality itself is reduced by from 2,000 to 100, and that's a significant reduction. So here, basically, as I said, I just give you a very flexible model, tell you some mathematical results. Now looking back, some of those restrictions like equicorrelation, or what I'm called here more generally called factor loadings, actually they have some ground for this because if you have too flexible, then you incur a lot of estimation error at the end of the day. No matter how you calibrate the model, you'll get too flexible. And with all these notes, let me say thank you. I think I'm within time.